What if a single company controlled America's entire coast-to-coast freight network? An $85 billion deal between Union Pacific and Norfolk Southern could make that a reality, and the stock market is already holding its breath. Welcome to Heart of Economy. Today we are not just talking about trains. We are talking about a potential merger that could reshape America's supply chain, impact multiple sectors, and trigger a ripple effect across Wall Street. If this deal goes through, it will not just connect railroads. It could connect every corner of the United States economy. But if regulators slam the brakes, the market shock might be just a historic. Let us break down what is at stake. Union Pacific has made a bold move, an $85 billion cash and stock offer to acquire Norfolk Southern. If approved, it would create a 50,000-mile rail network spanning from New Jersey's busy ports to California's critical trade gateways, all under one operator. To visualize the scale of this, imagine a single network stretching from the Atlantic Ocean to the Pacific coast, carrying everything from grain and coal to chemical and consumer goods. That is the level of impact we are discussing, but nothing is final yet. The Surface Transportation Board must approve the deal, and history tells us that is no easy hurdle. In the past, massive rail mergers have been blocked over fears of higher shipping costs and reduced competition. That is why the market is on edge. Possible scenarios. Scenario 1. If approved, America's rail superpower. If regulators give the green light, Union Pacific could become not just a dominant rail operator in the United States, but one of the largest logistics powerhouses in the world. Union Pacific stock could see significant long-term growth as it consolidates control over the nation's most critical freight corridors. For Norfolk Southern, $320 merger price is the key level. If approval comes, the stock could quickly surge toward that value. East Coast competitor CSX may be forced to rethink its entire strategy, and that could create waves of volatility across the rail sector. But the impact goes far beyond trains. Agriculture, energy, and chemical industries, all of which rely heavily on freight, could see their cost structures change almost overnight. Some companies may face rising expenses, while others, especially those in strong positions within the logistic chain, could gain a massive competitive edge. As Warren Buffett once said, railroads are the backbone of the American economy. This deal could put that statement to the ultimate test. Scenario 2. If blocked, regulatory shockwave. But what if the Surface Transportation Board says no? If regulators reject the deal, expect sharp and immediate drops in both Union Pacific and Norfolk Southern shares as traders unwind merger bets. A rejection could cast a long shadow over future rail industry consolidation, signaling that regulators are ready to step in more aggressively. Even competitors like CSX and Canadian Pacific Kansas City could feel the impact as investors start pricing in a new era of regulatory risk. Infrastructure investment plans may slow down, hurting equipment manufacturers, steel producers, and logistic technology companies that were expecting a surge in rail upgrades. This would not just be a corporate event. A rejection would send a signal to the entire United States logistics sector. Scenario 3. Long-term, a new era in supply chains. If the merger is approved and successfully integrated, we might witness a once-in-a-generation transformation of America's freight network. A seamless, coast-to-coast rail system could dramatically reduce logistics costs. It might intensify competition with the trucking industry and shift energy and fuel demand patterns. Billions of dollars in infrastructure investment could flow into steel production, concrete, and construction equipment manufacturing. This is not just about trains. This is about redrawing the economic map of the United States and redefining the way goods move across the country. Union Pacific is a driving force behind the deal. Its long-term growth potential extends beyond rail and into logistics technology. Norfolk Southern is in the spotlight with the $320 merger price as the short-term focus, and in the long term, it will become a core pillar of the new entity. CSX Corporation is the East Coast rival that might have to pivot quickly to maintain its competitiveness in a post-merger environment. Canadian Pacific Kansas City is another North American heavyweight. If this deal goes through, it may accelerate its own expansion plans to compete on the same level. Steel and infrastructure manufacturers like Nucor and Steel Dynamics could see a surge in demand. Logistics technology providers specializing in rail digitization and supply chain optimization may gain new opportunities. Agriculture and energy companies that rely on freight will need to adapt to new cost structures, which could create both risk and opportunities. Once again, these are scenarios, not investment recommendations. Always consult multiple sources and professional advisors before making financial decisions. The Union Pacific and Norfolk Southern merger is not just another corporate headline. It is a potential turning point for America's supply chain, the rail industry, and even the broader stock market. Do you think regulators will approve it? And which sectors do you think stand to win or lose the most? Share your thoughts in the comments below. For more deep and data-driven market analysis, subscribe to Heart of Economy. Like this video and turn on notifications. Until next time, keep your eyes on the rails and on the markets.